I just encountered one loss, which was due to a change of character in the market. So I think it's a big thing for us, right? It's a big thing for us. So this was the trade we took yesterday. We entered the market at 155 and we took our profit at 159, and some even went as far as 160, right? And remember, I told you yesterday that the market will first of all go up to manipulate, then go down to distribute, and that was what happened. And I actually took 2 profits yesterday. So when the market actually went up to manipulate, I spotted this double top pattern, which is a bearish indication that the market wants to go down. And then I saw a change of character over here, and I waited for this retest over here. When the market tested, I waited for this engulfing candlestick pattern, this bearish engulfing candlestick pattern. When it came out, I entered on the confirmation, and I actually made another profit over here, right? So we react to the market, like I keep telling you guys, we react to the market, but we have to look for reasons why we should react to the direction of the market. Okay, so in total we made 2 profits yesterday, and we're grateful. Right now, back to our discussion. So basically what we normally do, the first thing we normally do when we are trading this strategy is we look for the direction. That's the first thing. We look for the direction of the daily time frame to see what is the overall trend direction. And the overall trend direction has been bearish for a very long time now, due to the fact that this is a heavy time frame. It's a daily time frame, so it's going to take weeks before it changes character, right? So we are on the bearish time frame. We are on the bearish move. We've got our impulsive move, corrective move, impulsive, corrective, impulsive move, corrective, and I think we want to go into the impulsive phase. Now we make more money on an impulsive move, whether uptrend or downtrend. In an uptrend, we make more money on impulsive move than corrective move, because we can easily get stopped out when trading an uptrend on a corrective phase, right? Because the market is going down and you're looking to go up. Okay, so that aside, now since we know that we're on the downtrend on the daily time frame, we're going to put it at the back of our mind that we are on a downtrend. So we should be careful when trading long position. We should be careful and cautious, and we should actually adjust our risk to reward ratio when trading to the upside on a daily time frame. Okay, so we are on a corrective move, which is a pullback. Okay, so we got the impulsive move, and now we are on a corrective move like this. So we are looking to sell, but we're looking to buy, but what is going to guarantee us to buy is that you're going to see that we are having a weak bearish momentum, meaning that the market wants to pull back a little bit before it continues its up movement. Okay, now why does the market want to pull back? The market want to pull back because there's something called inefficiency in market, which is a fair value gap or a liquidity. Now a fair value gap is a distance between 3 candlesticks, like it's a space created between 3 candlesticks, which is considered to be an imbalance, a price or a place where buyers nor sellers traded because of the impulsiveness of the market. Now this is an imbalance, which is a fair value gap. So the fair value gap started from the lower wick of the first candle to the highest wick of the third candle. Okay, this is your fair value gap. Now the market doesn't like this fair value gaps. It doesn't like fair value gap, neither does it like liquidities that are resting above. Now this is the sell side liquidity. We call it a sell side liquidity because it's sellers that placed their orders over here, waiting for the market to come back and take their orders before going back down. Okay, I hope you understand that. Now the market will always come back to fill this liquidity over here, fill this space with candlesticks, and then continue its movement downward. So whenever you're trading, make sure you're looking at liquidity, make sure you're looking at fair value gaps, make sure you're looking at order flow, because that is what the market is responding to. The market movement, like that's the magnet attracting the price, okay, whether upwards or downwards. So now as you can see, you're going to see that there's a candlestick, or there are 2 candlesticks that has pierced through this. Okay, they have pierced through this fair value gap zone over here to actually correct price. It doesn't have to correct the price to all the way up. It can just tap the price and continue its movement downward. Now this is the fair value gap, and price might visit there again to actually balance it properly. But now what you're seeing is that the candlestick that formed day before yesterday, which was this one over here is a bearish candlestick, and the pattern is a bearish engulfing candlestick, which involves a green candle and a red candle bigger than the green candle, indicating that the market wants to continue to reverse to the downside. So this was the candlestick that gave us the double profit yesterday, because it went up to manipulate and then came back down. But when it came back down, it formed this candlestick pattern. It formed this candlestick pattern referred to as the inverted hammer over here. Now, the inverted hammer candlestick is a candlestick pattern that is indicating a bullish reversal to the upside. Okay, the inverted hammer is a bullish candlestick pattern that is indicating a bullish reversal to the upside. That's what an inverted hammer means. So whenever you see an inverted hammer, it's telling you that price might likely actually go up. Okay, so when I saw the inverted hammer yesterday at around 1 p.m, because I normally wake up every day at around 1 p.m. to see the opening of a new candlestick, to know where the manipulation is and where the distribution will probably be. Now, when I saw that, I waited to see if there's going to be a manipulation to the downside, which there was. This was the manipulation that occurred to the downside, and that means it might distribute to the upside, but we have to confirm that on the 1 hour time frame. Okay, so in order to do that, we are going to use this candlestick bias strategy that we are using on all our videos to actually see if it's going to be like that or not. Now, if you notice clearly, you're going to see that there's a wick to body contact over here, meaning that this market will continue to reverse to the downside. But in scenarios whereby the candlestick that gets formed is a reversal candlestick pattern, okay, meaning that price might continue to the upside, we have to use the guidance of the 1 hour or 4 hours, and then the entry on 15 minutes or 5 minutes. Only then can we be able to be at the safer side of the market, because just because the candlestick bias strategy is fantastic doesn't mean that it works all the time. No strategy works all the time. So if in your mind you have maybe you have done your analysis and the analysis is telling you to buy, but the market is telling you to sell, bro, sister, just sell. Okay, just sell. The market doesn't play with anybody. Okay, so that's just it. Now back to what we're doing. Since we have a bearish candlestick over here, that means we are going to mark the highest point of the candlestick and then the closing price of the candlestick like this. Okay, and then this is going to be our tradable zone. Over here is going to be our tradable zone. We're just going to be looking for sales over here. Like when the market moves up, what I mean is the market is currently going bullish, right? So we're just going to be looking for a double top candlestick pattern that will probably give us a bearish entry, and then we'll enter the market and then go down with it. Or we're going to be looking for a change of